Nalu FM Finance Podcast. Insight into the financial markets.
The problem with today's market is everybody has money, a lot of money, and there's pressure to pay up. So you need to have true conviction.
This podcast is powered by Vesta, the engine behind active management. Vesta is a Switzerland-based fintech startup that provides software for issuers of actively managed certificates to automate their value chain fully. Visit Vesta, VESTR.com to schedule a meeting with an expert and to learn more about Vesta.
I'm very excited. I got a new guest, Joe Sarachek. Thank you, Joe, for taking the time. You are a lawyer, an investor, but you also like to give something back, teaching at NYU Stern School. But your passion basically is distressed investing. You've spent decades on both the legal and investment side in this trip. For listeners who may not be that familiar with distressed investing, what kind of situations or assets fall under this category, and why might someone deliberately invest in a company that is in serious trouble?
Sure. So it's not just companies. So I categorize it into four segments, and they are what I call trade claims or accounts receivable, real estate notes or mortgages, special situations like investing in a litigation, and operating businesses. Like operating businesses are buying a business that's in trouble and turning it around. Unlike investing in healthy companies, the investment in a distressed asset has an element of turnaround, and therefore there'll be a bump or an increase in the return on the investment if done properly.
Okay. Now, some people might think it's sort of distressed investment is taking advantage of somebody. It's sort of a vulture stigma. Gets a bad rap, you picking up, for pennies on the dollar. How do you describe the value or opportunity in distressed assets to someone who is skeptical? Why can it be a positive and obviously profitable strategy to do that?
Yeah, there are the terms vulture investor, bottom feeder, grave dancer, but that's really not what it is. Great things can come when someone is investing in distressed assets, such as creating or saving jobs. And like one of my favorite cases of all time was a bankruptcy in Iowa where thousands of family were dependent on a business that when I came in was shut down. I was brought in as the trustee, the bankruptcy trustee. We restarted the business, and the business employs several thousand people, but regionally it probably employs tens of thousands of people. So that's like a turnaround, and that's a feel-good story. And I didn't buy into that business like as an investor. I was hired as an advisor. But had I bought into the business and let's say bought into it for cents on the dollar for deep discounts and saved and created thousands of jobs, you wouldn't call me a vulture, would you?
No, I wouldn't. Now, in these cases, it was planned to go into such an investment, but I assume many investors sometimes, end up unintendedly in bond or stock, or in a company goes bankrupt. What can they do when they end up in such a situation? What should they do?
So this is why there's a market in distressed assets. Some investors should just sell. They should get as much cash as they possibly can and put that cash to work in something else. That's the right thing to do. Other investors who have a vision, who have patience, and maybe even more capital to deploy, then they should consider being buyers. Obviously, it's a case-by-case situation. There are some situations that are just so rough and so bad, and that you're better off cutting your losses.
Now, what are the things that you can look out for to avoid actually getting to that situation? What are the red flags, the warning signs?
Sure. The first sign is a high debt load and the inability to service that debt. There are just some companies that have so much debt. You know, if a business is faced by unexpected things like the pandemic or tariffs, that's a different story.
Now, also often I find people don't understand actually where they sit in the capital structure, equity, subordinated debt, preferential equity, what other. Can you explain why it's important for them and how an investor recovery prospects depend on their position in the capital structure?
Sure. Whether a company is in bankruptcy or not, all investors use the same rules of priority in getting paid. For instance, the senior secured lender or creditor is paid first, and typically has a lower return profile, like an interest rate. The trade creditor or unsecured creditor is paid after the secured creditor. And of course, lastly, is the equity holder, and that's the most risk and should also be the greatest return.
Is there anything in there also in these rules when you get paid?
So the answer is, in the US bankruptcy code, there's a process after filing bankruptcy that allows a company a certain amount of time to file a plan of reorganization. The company also has to file a document called the disclosure statement. And that disclosure statement spells out the form of consideration you're going to get and also when you're going to get paid.
Now, if you have all the information, hopefully that you can get, and it's very very deep and a lot, but when you evaluate a troubled company, how do you determine whether its asset can cover its liabilities? Do you look at the liquidation value of hard assets, ongoing cash flows, brand? I mean, goodwill. I don't know how much that is worth when you're in trouble, but to determine a realistic recovery rate, because you said it right at the beginning, you need to know what your absolute, how much could you lose, and that's probably determined by your recovery rate.
So it really depends on the size of the company and the type of asset. And I have 6 rules in my book I talk about, but one of them is determine the liquidation value. And it really starts there. It's never good to value a company based on some value that the company thinks it's worth, because let's face it, companies in distress are, they're idealistic. The value that they're going to give you is always greater than it is. With retail businesses, there's really only a couple of assets, the inventory and maybe the real estate. And there are ranges that inventory typically liquidates out at. Real estate is pretty efficient. And of course, it depends whether the asset is owned or leased. But usually in large distress situations, the market has told you even before the company gets in trouble what the assets are worth. And you can just look at what the debt is trading at. So the market is typically in large situations efficient.
Often how these companies get in trouble is often by not managing their cash flow. We often see businesses that are asset rich, but cash poor and end up in distress. So how important is liquidity, day-to-day cash flow in this case, and preventing or driving a bankruptcy?
I mean, it's a universal principle in all businesses everywhere, which is, if you run at a deficit, at a loss, if you're not making money day in, day out, you're increasing the riskiness of the business. Simply put, you want to generate positive cash flow in all businesses, that you start as quickly as possible. Otherwise, the control shifts, 1, to the financing source, and 2, to the creditors.
which is a little bit my next question. When you go into these distressed situations, this involves numerous players with competing interests, senior lenders, junior creditors, management, shareholders, employees, unions, whoever, pension funds, regulators, courts. How do these stakeholder dynamics influence the outcome of restructuring or bankruptcy? Like, if all small guys get together, can they actually shift the power dynamic in this versus a large person who bought maybe up 20% of the debt?
So I represent often as a lawyer when I'm not, with my investing hat on, I represent vendors and creditors and little guys. And yes, I do pull them together, but the reality is he who has the gold rules. So the senior creditor, he rules, he controls, he calls the shots. Now, we do our best and we have all sorts of very clever techniques to level the playing field. At the end of the day, what's this all about? This is all about there's a limited amount of money, and we want, on behalf of our vendor clients, as much as possible.
Okay. We always say, buy low, sell high, in a sense. This comes from the trading side. But I think the same thing applies here is investing, that you make money by buying it, hopefully cheaper than what you can realize or sell. And, how do you evaluate the price you pay for a distressed debt or equity position relatively to its likely recovery value? In other words, what's your process for determining if an investment is cheap, in quotation mark, enough to be attractive given the risk? I mean, I remember FTX, people, the claims of trading very cheaply, and then suddenly they realize, hold on, they also have these huge investments in other company that's worth actually something.
Yes. The number one rule, the most important rule in distressed investing is buying right. And I spent a lot of time in my book, the Distressed Investing Playbook, talking about this and how can you make sure that you're buying right, and how do you do the right analysis and due diligence and have the patience to do it. I've had situations where I bought right, so right that I locked in instant profits. And I've had situations that are rougher where I paid too much, and the balance of my life with this investment opportunity, I'm basically trying to get back my principal and protect, myself and my investors. The problem with today's market is everybody has money, a lot of money, and there's pressure to pay up. So you need to have true conviction.
There's two different type of strategies, sort of trying to get the business and then actually operate it, or versus, trading, buying the claim and then selling it, hopefully, which is more of a passive approach. Can you compare sort of these two approaches? What makes sense for certain investors?
Yeah, I talk about this in my book, Active versus Passive. I prefer being a passive investor and much more of a trader. I love liquidations and event-driven recoveries where the risk is minimized. Distressed investing should be about minimizing risk. Being an active or a control investor has so many more variables, some beyond your control. I don't like being up at night worrying about, are the sales coming in? Did all the employees show up for work? Is there a new tariff in town today that we didn't know about, yesterday?
But obviously you have to gauge somehow. I mean, what is the likelihood in a distressed company to actually to turn around operationally? And do they just need more capital? Do they need to refinance themselves? I mean, in your experience, how important is the viability of the underlying business to the ultimate success?
Operational turnarounds are tough. In my experience, the success of one is part fundamentals and part luck. Uh, One of the most important things that's often overlooked is an industry expert leading that company That's far more important than a bankruptcy professional.
The playbook is full of, vivid world examples from your career. Could you share one of your favorite war stories where they
Sure.
like maybe the company looked like a lost cause and lots of
Sure.
surprises?
So this company was called Petrowax, and there were a couple of factors. One, the fund that controlled it had a lot of dry powder. And two, we had a very experienced industry expert who had an idea about how to effectively create a new revenue stream. You want to effectively buy low or restructure low and sell high.
And is there anyone like on one where you had a failure basically, or it didn't go the way you were hoping? What sort of were your takeaways, and what did you learn from it?
Yes. So in every situation, and I'm going to write my next book is going to be what I learned from my failed distressed investments.
Yeah.
What I learned was I backed the wrong horse. Lesson one. The next point is don't spend a lot of time on small deals. Small deals rarely yield large returns. I'd say lesson two is, or this might be lesson three, is if you have a bad feeling about someone, run,
Yeah.
move on. Don't do the deal. Well, you've had that happen in life.
Every time, I'm like, I should have just listened to my guts.
And your gut is based on your collective experiences. The next lesson is you're always going to need more money than you think.
Now, if somebody wants to get started in this business, if someone wants to break into distressed investing, where do you get started if you want to do that?
There's no doubt a legal or accounting background is definitely a plus, but the best way, and this is what I say to my class, is to get involved in something a business an industry You have a skill set.
I mean, when I was trying to learn things as well, because I originally came, with a computer science background into finance, I was trying to look at the people out there that I really thought knew what they were doing and try to learn from them. Is there are the distressed investors or firms that you think are worthwhile to be studied or to be followed?
There are some great ones. Elliott, Oaktree, a great one. Anchorage, Davidson Kempner, Mark Lazary. The greatest thing about the time we live in now, you could put Google alerts out and follow people, literally follow them and get information about the deals they're doing. Listen to Bloomberg News, read the FT, read the Wall Street Journal, read Substacks, read your column, read my Substack, the Distressed Investing Playbook. Those are places where for free you can get information.
Now, looking ahead, what's happening here. What big picture trends do you see shaping the distressed investing landscape in the next few years? Are there factors like the rise of private credit versus private equity, change in interest rates, everybody's, or new restructuring law that you think will create more or fewer distress opportunities going forward?
This is a very timely question with the blow up of First Brands. Private credit is a train wreck waiting to happen.
Okay, we're full agreement here. Yeah.
These are funds that have massive, massive amounts of money, and they need to put out 100 million, 200 million, 500 million. And the reality is there's just not that many situations to do it in. It's unregulated, and distressed investors and up and coming distressed investors just need to follow the deals that are being done. And by the way, even though they're private companies and private deals, if you follow business development corporations, BDCs, which many of these private credit funds fall into, you can go online and you can, meaning in the SEC filings, and you can see what positions they are marking down quarter to quarter.
Yeah, good point. Finally, what should be for the listeners in a sense? What's the one lesson they should remember if they haven't read your book?
Your next deal is in your backyard. You already know the subject matter of your next deal, and anyone with common sense can make money. The objective is to buy low, sell high. You just need to do your due diligence and buy it right.
Joe, incredible enlightening. Thank you very much. Last 2 or 3 questions for you, so a little bit people get a feeling who you are, maybe a little. So what is, what drives you, or can you tell us something interesting about yourself that maybe not everybody knows?
Okay. Most interesting thing recent is every morning I get into 49-degree water Fahrenheit in a cold plunge. It's freezing cold. I end up shivering. My chest is red as anything, but I've really enjoyed this cold plunging. It wakes me up. I feel it gives me tremendous energy. That's one thing. 2, I love distressed investing. I want to bring distressed investing to the world.
What is your personal definition of success?
Great question. The most important thing to me is my wife, Heather, and having a meaningful relationship. I feel right now I'm very successful in that area. And of course, I have 5 kids, my kids as well.
Last question. What is on the top of your current music playlist? What do you like to listen to?
Oh, I'm a deadhead. So and I love John Mayer. So I love John Mayer is in Dead and Co. And I went to see him in San Francisco. And this up and coming guy, he's more than up and coming. His name's Billy Strings. I like jam bands. And you? What's your
for me, it's easily to define what I don't like. I do not like anything beyond really heavy metal. That's where I stop out. Anything above AC/DC, probably. Free jazz, when it gets completely chaotic, I don't like. And also 12-tone music. The classical side becomes, the Russians, when they do too many, instead of octaves, they do 12. That doesn't gel with me either. But otherwise, pretty much anything you can dance to, probably I will like. Thank you, Joe. That was extremely insightful. Thank you for taking the time.
Okay, you're welcome. Be well.
Nalu FM Finance Podcast. Insight into the financial markets.
This podcast is powered by Vesta, the engine behind active management. Vesta is a Switzerland-based fintech startup that provides software for issuers of actively managed certificates to automate their value chain fully. Visit Vesta, VESTR.com to schedule a meeting with an expert and to learn more about Vesta.